Jeni Browne. Welcome to this week's edition of MFB News. And no, I haven't moved. I've just switched my office around. So essentially I was sitting there before and now I'm sitting sort of behind where I was sitting last time. So a change is as good as a rest, as they all say. And my word, I feel like I could do with a rest at the moment. So this was the best I could conjure up last minute. Enough about me. What are we going to talk about this week? We're going to do our usual rundown on what's been going on with swap rates, lender pricing changes, lender criteria changes. And then we've got kind of three features for you this week. We're going to talk about the Green Party, we're going to talk about inflation, and then we're going to wrap up with talking about what rental yields are doing by region. Okay, so starting off as we always do with swap rates, and the good news is that they haven't moved and the bad news is that they haven't moved. And why am I saying it's kind of both things? So obviously we'd all like swap rates to come down. That's where it's a bad news that it hasn't moved. But the reason it's good news is that actually at the moment there is so much speculation with regards to the autumn statement. I think it's like the leakiest of leaky governments in terms of and apparently this is a thing, things get leaked out into the public domain to kind of test reaction from the public to how things land. Whether that's true or not, I don't know, but I mean, if it is, it's ridiculous. Very, very leaky, lots of rumours going around. The markets could be reacting to these. The fact actually that swap rates haven't jumped up, I see to be an actual win, given the kind of, rumours that are going around at the moment and the impact these could have on things like inflation, on the economy and so on and so forth. So that's why I say good news that swap rates haven't moved as well. So in terms of where we are, so actually, like I said, things haven't really changed again. So 2-year swaps 3.71, 1 month ago 3.65, and 1 year ago 4.06. 5 years 3.79, 1 month ago 3.71, and 1 year ago 3.80. So actually, really, things haven't moved. And so what does this mean for mortgage rates? So as we've mentioned in previous weeks, if lenders' cost of funds aren't changing, it doesn't leave a huge amount of wiggle room for lenders to be making large changes to their product set. So lenders tend to try and make a set amount of return per pound of mortgage lending that they do. So when interest rates go up, it's not like lenders are suddenly making more money because their cost of funds have gone up as well. So actually, say they're adding a 1% margin, so their cost of funds is 3%, therefore they have to charge you 4%. If that 3% became 2, they would charge you 3, and if it became 7, they charge you 8. So they're still making the same amount of money. So what happens is when swap rates don't move, so their cost of funds aren't changing, actually they're kind of stuck in a position where it's like, well, the only way we're really going to be able to fiddle around with our rates and drop them down is if we take a cut on the amount of return that we make. And some vendors will sort of try and dabble with this, but fundamentally they are businesses with overheads. They can only do so much. Otherwise, they don't make the returns and it's simply not worth them bothering in the first place. So that's kind of why we're not seeing large changes in pricing at the moment from our lenders. Now, we have seen a bit of tinkering, which is, absolutely fine. We've seen Aldermore Mortgages re-release their 2-year limited edition products. Aldermore is a lender, specialist lender, very, very good. Limited companies, trading limited companies, layered companies, no maximum number of properties in the background, no minimum incomes, all the things you kind of know and love about specialist lenders. The thing that Aldermore have, which is broadly unique, I say it because one other lender offers the same thing, is a multi-unit property offering. So this is where if you go to them with, say, 3 properties, they can underwrite them as a single mortgage. Why would you want to do this? Some people really like it. It means that it's one mortgage application, it's one mortgage account to manage going forwards, it's one mortgage payment coming out, so it sort of streamlines everything. Some people don't like this because they like to keep everything very separate, so one mortgage per property, so that if they go to sell a property in the future, it's very, very kind of safe for them to assume that actually they would get the proceeds of that sale. Whereas if you have a portfolio loan, the lender may say, well, actually, we know you're selling your property, but we're going to take all of the money from that sale. We're not going to let you keep any. So there is a kind of loss of control, I suppose, with these portfolio loans. But like I say, some people really love them. BM Solutions have made a very interesting change this week. So green mortgages. So a lot of lenders these days offer a mortgage set for properties which they class as green, which is an EPC rating of A to C, and then another set of products for those which are a D or above. And the benefit of having a green mortgage rate tends to be a saving of around 0.1% compared to the non-green counterpart. So what BM Solutions have done is change the requirement to be eligible for their green products. So now they're no longer accepting properties with a C rating, only an A or B. So if you have a C rating property, BM Solutions would put you into the non-green category. I find that a really unusual move. They're talking about it kind of keeping up with requirements, but I personally don't get the kind of alignment there, but that's what they've done nonetheless. I'm hoping a lot of other lenders don't follow suit, if I'm really honest, because a lot of us will know that actually even getting a C rating is no mean feat. So watch this space on that one. Cumberland have reduced holiday let rates by up to 0.4%. Cumberland are absolutely exceptional at holiday let. So this is your bag. Cumberland are brilliant. They underwrite based on the actual income you would receive from the property, not a notional AST rent. Their rates are really, really good. They can lend on some fairly quirky properties as well. They're quite particular about location. So if the property isn't in a kind of tourist destination, you're going to find it harder to get a mortgage with these guys than if it is. So just one thing to be watchful of there, but good to see they brought their rates down by that amount. Now, last week we did touch on the fact that we've done a Meet the Lender episode with Paragon Bank. So actually, while we're just talking about lenders a bit more, it feels like the opportune moment just to talk about the fact that we did a Meet the Lender with Moises from Keystone Property Finance. And Keystone are a really interesting lender because they are really quite old-fashioned, I suppose, in the way that they do look to make commercial decisions on every single case that they do. So these days, with technology coming more and more to the fore, what we're seeing is less and less autonomy with underwriters to be able to kind of make decisions on cases. So there are lots of lenders who are looking to lend at volume and using computer-based decisioning to kind of support that, which is great if you tick all the kind of standard boxes. The minute you stop ticking those boxes, you really need to start thinking about those lenders who are employing people to pick up the file, take a look at the whole story and make a decision as to, actually, is this person within our credit appetite? And this is where Keystone sit. So it was really, really great that Moises was able to spend some time talking to us. And one of the things that actually we get asked a lot by people is the Renters' Rights Bill going to impact the way that lenders underwrite mortgages? So actually with the abolishment of, for example, Section 21, and moving on to sort of rolling tenancy agreements, is this going to actually mean that lenders kind of want, I don't know, more equity in properties for the landlord to have a large amount of savings to cover this? Are they going to insist on landlord insurance? How's this looking? So we were really, really pleased to be able to have that conversation with Moises and just feel interested. Here's an excerpt of what he had to say.
So at Keystone, how do you think, if any impact at all, the upcoming changes in legislation are going to impact how you guys choose to lend?
I don't think that'll be a departure in terms of any criteria that we have to change. I think it's got a wider implication in terms of the types of borrowers that will start to think, is buy-to-let something that's worthwhile as an investment? Because I think a lot of the larger landlords, what will happen is they will gear up their systems to cope with it and to cope with all the intricacies of actually making sure that they serve, when they're serving notices correctly, etc., that the properties are getting registered on the registration portal. A lot of smaller landlords will probably think, do you know what, this is too much effort.
Too hard bucket, yeah.
There's too much involved in possibly just running, 2 or 3 buy-to-lets. It may put some people off, but again, I think there'll be opportunity for others. And there'll be opportunities, I think, for larger landlords that have got the ability to kind of manage this on a macro basis.
So that was Moises from Keystone, and if you would like to have a watch of the whole video, you can click on the link that I'm sure our wonderful marketing team included for you just now. Now, moving on to lender criteria changes, as we've been kind of touching on that with the Moises video just now. What's been happening there? And there have been actually a little flurry of lenders changing pieces of their lending criteria, which are quite interesting. So the first one is the HSBC are changing the way that they underwrite buy-to-let mortgages by introducing top slicing. Now, top slicing is where a lender is looking at the rental income that the property is achieving, and they're saying, well, actually, it's not quite meeting our rental calculation. However, we can see that you have got absolutely loads of personal disposable income in the background. Therefore, this is still very much affordable to you. Now, there are lots of lenders who offer this facility. It can be very, very useful. It mainly works for those people who don't have lots of properties. So if you've got more than 4 buy-to-let properties in the background, you can probably forget using top slicing, if I'm honest. But for those of you who've just got maybe a couple of buy-to-lets in the background, this can be quite useful for giving you access to those lenders who you maybe wouldn't be able to access because of their rental calculations. So by this, what I mean is that when I think about those lenders who do top slicing, we've got people like Barclays, Clydesdale, now HSBC, and then some other really good high street lenders who offer some very, very keen rates, but their rental calculations, because their appetite in buy-to-let is fairly kind of low, they're quite cautious lenders. So actually you wouldn't be able to access their rates ordinarily, but because of the top slicing you could do. So there's a couple of income requirements here. The first thing is to be able to access top slicing with HSBC, you have to be earning at least £50,000 a year. And they are saying that while we are going to be factoring your income into the equation, there is still a calculation where the rent has to fit. So essentially, rather than saying 145% coverage, they're now saying it would have to be 110% coverage, which is pretty much in line with the rest of the market. HSBC is a lender, we don't use them much, if I'm honest. They're not particularly landlord friendly. I've just told you something that makes them sound really landlord friendly, but they're really looking to lend to people with, you know, a couple of buy-to-lets in the background. They also have got some nice pieces of lending policy which sit around property types and age, so don't rule them out entirely, but they're just not really looking for you know, people with a portfolio, just looking for people with 1 or 2 in the background. Now, the Mortgage Works have done an interesting change to their criteria, but it's more about actually their offering. What they're now doing is introducing free legal work for limited company remortgages, which is really, really good, I think, anyway. So you guys will know that actually when you do a remortgage and the property's held personally, there are lots of lenders, particularly if you're in the kind of high street end of the market, who will offer you free legals on the remortgages. Now, I just would caveat this by saying the free legals are often not the greatest experience in the world. So the solicitors who are doing this are doing high volume conveyancing work. They're not kind of, in my experience, the greatest service. They can be very hard to get hold of. However, the theory is that for a remortgage, it should be a really straightforward transaction. Okay, it should be very light touch. And so actually, it shouldn't really matter if they're not the most kind of like, you know, customer service based offering. Having done a remortgage myself with a really, really terrible solicitor last year, it does matter. But, you know, for those of you who have had experience with free legals and found it to be palatable, the Mortgage Works are now offering this. The reason I think this is a good thing also, actually, just to say, is when you do limited company remortgages, it can be quite expensive from a legal perspective. So to give you a guide, when I remortgaged my limited company flat last year, I used a legal firm. I was borrowing, I can't remember, about £170,000, something like that. And they charged me about £900 for the transaction. So the reason it was expensive, A, it was a limited company, B, it was a leasehold property. So, you know, that kind of added on cost, but it was really expensive. So the fact that the Mortgage Works were offering free legals could be a really good saver for some of you. And actually, I hope more lenders now choose to follow suit. And last thing in terms of lending criteria change is that Moda Mortgages are now accepting layered limited companies. So this is where we have a SPV limited company which is owned by another company, which is then owned by people. So some of your kind of cheaper lenders, should we say, your clearing bank, your non-specialist limited company lenders, which is a new category that I'm bringing into the market, these guys will lend to limited companies, but they can't be layered. It has to be a company owned by people. We're seeing more and more companies coming into play now where we have this layered structure. I think it's largely linked to inheritance tax planning, estate planning, if I'm honest. So actually, yeah, the fact that Moda are now coming into that space as well is absolutely wonderful. Okay, so for those of you who are watching this and you're about to sit down for a nice relaxing evening, probably skip this next segment because it's going to make you probably really ragey in the same way that it has done me. And I thought I would share that with you. You can join me in my annoyance. So in the last week, the Green Party has passed its Abolish Landlords motion. So at this recent party conference, the Green Party passed a motion to abolish landlords, believing the PRS has fundamentally failed. The motion is accompanied by text that claims private landlords add, and I quote, no positive value to the economy or society. They have listed a 6-step plan to abolish landlords, which include things like introducing rent controls, abolishing right to buy, removing finance for landlords and ending buy-to-let mortgages, as well as moving forward a land value tax on owners, not on tenants. At the same time, the motion is urging more finance support for councils and tenants with the scrapping of Section 21 evictions. Now, just to be clear, the motion, though passed by party members, has yet to be debated, so it doesn't necessarily kind of form part of their manifesto. So if they were to come into power, this is something they would execute. But clearly, the Green Party are very, very anti-landlords, basically, because they want to abolish us. They're going to save the polar bears, but abolish landlords. Now, the Green Party have declined to comment on this particular point. However, Green MP Carla Denyer has sought to distance themselves away from the wording abolishing landlords. She's quoted as saying that while the motion to the conference had an eye-catching name, it does not actually abolish landlords. It does, however, address the housing crisis. It empowers tenants and improves their well-being. It contains a range of policies which over time would reduce the portion of housing market that is privately rented and increase the proportion of socially rented homes. There you go. So I just thought I'd kind of throw this one out there for those of you who were thinking about voting Green. And I'm absolutely not saying you shouldn't, but it's probably just worth kind of knowing that this is where their position is on the private rental sector. Just carrying on with the cheerful news for a moment, and we're going to talk about inflation. And fears that inflation will remain well above the Bank of England's target of 2% were intensified on Thursday after a closely watched survey of businessmen revealed bosses plan to raise prices at their fastest rate since the height of the cost of living crisis. And in addition to this, British businesses also have the weakest hiring intentions since 2020, with firms expecting to keep employment steady over the next 12 months. At the first time since the 3 months November 2020, they had not expected to increase staffing. So essentially, prices are going to go up and businesses are not looking to hire. So think about that in terms of context of cost to you at the till, and also then the job market as well. So finance chiefs polled by the Bank of England said they expected to hike their prices by 3.7% over the coming year, which is up from 3.5% in August. And this is a move that spectators are saying could quash any remaining chance of there being another Bank of England base rate cut in 2025. Inflation expectations also remain elevated, with bosses on the bank's decision maker panel, the DMP, predicting prices to rise across the UK economy by 3.4%, which is the highest reading since December 2023. The findings mirror the results of the central bank's recent survey of households' inflation expectations, which, driven by recent spikes in grocery prices and regulated industries, is now at its highest rate in several years. So both surveys will add credence to recent arguments made by some of the MPC's more hawkish members, who have warned that inflation outlook looks stickier than officials had previously anticipated, therefore maintaining and reinforcing the argument for base rate to stay on hold for the foreseeable future. There you go. So another bit of really disappointing news there with regards to inflation, and also therefore the knock-on impact to interest rates. And yet again, another reason why we're not seeing things jump around with swap rates. We're not seeing those come down, because actually there's no real expectations that base rate is going to move downwards anytime soon. It's kind of any potential cuts are being pushed out into the future because inflation is staying so incredibly sticky. In a bid to try and lighten the mood somewhat after those two things, and I'm really sorry, I don't like delivering negative news on this particular channel, but I think it's really important that we're honest with what's going on as well. There's no point kind of hiding from reality, and I feel like when you're informed, you can make better decisions. So I think that's why it's important that we talk about these things. However, we are going to end the episode on a slightly more positive note, because we'll talk about rental yields. So Fleet Mortgages have released their latest rental yield report, and actually it makes relatively good reading. So a bit of background first of all. The North East remains the top yielding region across Q3 with rental yields of over 9%. So for those of you who are really chasing rental yields, which is very, very normal in a period of time where people are feeling particularly restricted in terms of their cash flow, yields become very, very important. So over 9% is actually incredible. So the North East could be one to consider if that's your bag. For fleet mortgages, over 61% of applications were from portfolio landlords holding 4 or more properties. This is really where fleet mortgages kind of do the lion's share of their business, is for portfolio landlords. Limited company borrowers continue to dominate, making up 81% of all of their applications. And this is kind of relatively reflective in terms of what we see at MFB. So I wouldn't say 81% of our applications, or all applications, are limited company, but certainly 80% or more for purchase applications are now done using a limited company, which is great. It's good to see people are kind of going down that road. High demand, 38% from those looking to add properties to their rental portfolio. So actually people are still buying despite all of the stuff that's going on at the moment. Landlords are honestly the most resilient people I've ever come across in my life. And first time landlords are also holding steady, representing 12% of all applications. So actually there are still people who are coming into this market for the first time as well. And good for them, what a great place to be. So in terms of by region, what's been going on there? So the highest yields, as I mentioned earlier, in the North East at 9%. I'm literally going to go down from top to bottom here. So 9% North East, 8.5% North West. Wales are at 8.2%, as are Yorkshire and Humberside. East Midlands yields are at 7.5%, as are West Midlands. The South West are at 7%. East Anglia 6.6%. The South East 6.5%. Greater London 5.9%, giving an average yield across the UK at 7.5%, which is up by 0.3% year on year. So actually there's a reason to be cheerful, if nothing else. And finally, just very quickly, thank you to those of you who contacted me with regards to making tax digital and what you're doing about it, what you're going to be using for your accounting going forwards. And overwhelmingly, the landlord responses that we've had seem to be people are favouring a piece of software called Hammock. So my mission in the next week is to register for that, have a little look at it and a fiddle around, and I will be reporting back properly in next week's episode. But if there are any more of you who have any other kind of pieces of software that you are using, do let us know. I'd love to go and have a little look so I can kind of share some feedback more publicly. Have a fantastic week, and as always, if you do need to speak to us, you know where we are, 0345 345 6788. I'll see you again next Wednesday.